As we've been studying the global economy in this class, we're aware that there is this thing called the global financial crisis. Again, with me today is Professor Mitchell Smith to talk a little bit about what that means. Professor Smith, what can you tell me about what that means, the global financial crisis?
Well, we've spoken about the linkages in the global economy through which flows of capital are linked across, connected across countries. And the global financial crisis is a manifestation of the dangerous side of that, which suggests that when there's financial turmoil in a major country, and of course in the recent case it started in the United States, it could very easily and rapidly be transmitted around the globe with dire consequences. As it turned out, in this most recent case, the very place where it started was the country that had perhaps the greatest capacity to deal with it, so that it was possible to resolve some of the worst effects of the crisis here, even as the effects rippled out elsewhere across the globe.
Well, before we talk about the spread of the crisis, because I want to get to that, first let's talk about what does cause it. What was the cause of the global financial crisis in the United States before it then began to spread?
I think it's very interesting that the debate about the causes of the crisis continues, and there will never be uniform agreement on what caused it. But I think, to me, it seems one thing is very clear, that what the financial crisis is about is insufficient regulation of capitalism. Capitalism itself is an inherently robust system that produces a lot of beneficial things. It needs to be regulated effectively. We have ample evidence of that. Poor regulation, insufficient regulation, produces dangerous consequences. And I think we saw a manifestation of that in the financial crisis. I would also add that I don't think we fully learned those lessons, even though many policymakers and economists recognize the lessons. The politics of enacting those lessons is a different story.
So when you say insufficient regulation, you mean like in banking and lending, mortgage lending that wasn't sufficiently regulated. Is that what you mean?
Yes, absolutely. Many people tell the story about how people borrowed beyond their means, and in many cases, of course, that's true. However, that by itself would not have produced a financial crisis. What produced the crisis was the ability, for example, of unregulated mortgage lenders to do things like initiate mortgages, charge fees for doing so, not worry about the creditworthiness of the borrowers, lend the money, and then package the mortgages and sell them off and spread the risk throughout the financial system. And then when those mortgages, when the default rate increased, that instability was spread throughout the financial system, much wider than it would have been if this was just simply a matter of a few people borrowing beyond their means. And the leverage involved is the borrowing that many firms did on those assets. The investments in the mortgage-backed securities led to further amplification of the consequences of this. And of course, it turned out that some of those assets were held even by banks in foreign countries, in Europe, for example. And so they were not immune from the effects of the crisis that started here in the United States.
So let's talk about that next. So as the crisis began in the United States, because some of those assets were owned by other countries, other financial institutions in other countries, that means that it had an impact on those countries. And we've talked earlier in this course about interdependence and how things that happen in one part of the world can have an impact on the other part of the world. This is a fine example of that, right? So how did this happen? It spreads then to Europe, which is continuing to experience its global financial crisis.
That's right. And interestingly, I actually was in Europe at the time that the crisis sort of hit the headlines in the United States. And there was very much a sense in places like Germany that here we have evidence that American capitalism is insufficiently regulated, but our capitalism here in Europe is different. We're more insulated, we're more effectively regulated, and we're not going to experience those same sorts of hardships. And of course, within a matter of weeks, all of this spread to Europe as well, really demonstrating the extent to which the interconnections in the system are in fact very powerful. And then, of course, the events in Greece began to happen as well. Greece was a case, unlike I think many of other cases where financial crises have started, where in fact the government had borrowed excessively. Many people looking back on the financial crisis in the United States think that it was a debt crisis. It was not. The debt that the United States government built up, and the budget deficits that were built up over the last few years, were in fact a product of the crisis, not a cause of them. In Greece, it was the other way around. Debt certainly and bad management of finances by the government led to a crisis that as you indicated, spread throughout the Eurozone, the countries that use the euro as their currency. And of course, they're still dealing with the aftermath of that situation.
So clearly this is global in nature in the sense that it begins in the United States, it spreads to others that it's connected to economically in Europe and elsewhere, and also in Asia. But let's get to this issue of what do we do about it, right? So what are some of the measures that have been undertaken in order to stop the bleeding, to fix the global system and end the crisis?
Right. I would emphasize two things. One, I study Europe most closely, and the European case, they are trying to move toward creating mechanisms to provide for greater stability. They have something called the European Stability Mechanism, which tries to balance two things. One, making funds available to governments and to banks in cases where financial turmoil erupts, but at the same time imposing conditions on them so that they try and behave in a way that doesn't create or exacerbate crises in exchange for getting these funds. At the same time, as the Europeans have moved toward some of these measures and moved toward a banking union to try and stabilize the banking system, they've encountered some of the same problems that exist in the United States, which is the economic solutions and the politics of getting there diverge, and there's a very strong tension between the two. As I said, I think in the United States, while economists and policymakers recognize a lot of the things that must be done to stabilize things and at least either mitigate the next financial crisis or make it less likely, politically it's very difficult to implement those measures.
Because this isn't a painless process, right? There are those within the community that, let's say, those who didn't even borrow, engage in risky borrowing practices, the austerity measures that come with that, the cutbacks. I mean, there are lots of things that then everybody assumes some sort of cost for this crisis.
Absolutely. I think we all feel it. Some of us feel it less than others, but from higher unemployment to more long-term unemployment to college graduates having a more difficult time finding jobs or finding jobs that pay them enough to be able to pay their student loans, to many other consequences. People trying to obtain home mortgages, for example. People trying to move to places where they can find a job are unable to sell their home because of the effect on them in the mortgage market. And so at many levels this operates, and I think affects really pretty much every one of us.
So students, tell us what you think. How important is the global financial crisis to you, and what would you do about it?